Hello everyone, welcome to the fourth strategy. Today in this video we are going to see what is short ply, and this is the series that we are doing for high volatile market conditions for low capital traders, typically a capital of less than 3 lakhs. So the bare minimum capital that we are going to you would be needing for this series is somewhere around 1 lakhs. And let's straight away jump into it. The first part that we have seen, Batman strategy, then bull call spread we have seen, and recently I have also posted the reverse jet desert, and this is the fourth strategy that we are going to see. All these strategies are neutral strategies, meaning we are expecting that the market to stay in a specific band. So a lot of comments that I am seeing, without adjustments, the Batman strategy is getting into losses. I have done some 6 months of back testing, 3 months of back testing, and questions are around that. Reason is we have seen that the market has rallied so big time. In last 6 months, you have seen that market was trading somewhere around 42,000, 43,000. Now it is trading around 48k. So 5,000 points of move has happened, and in between there are a lot of events and news. So you got to know when to apply which strategy. So no strategy would be working 365 days of the year. You can make it work provided you know the kind of adjustments and the kind of capital that you have. With limited capital, what best we can do, we are trying to cover in this series. So the first thing about short iron ply is, let's see the capital requirement. Typically, like all the other strategies, this also requires about 90,000 rupees for all the legs included. One word of caution is that this is big players' favorite strategy. All the big players, option writers, does only this, and they don't look for any other strategy because the kind of returns that they get from the strategy is super big, super good. So they stay with the strategy. But the problem is, we as retailers cannot afford to make many different adjustments if we are having limited capital. The big players were able to do it because they have something called money management, discipline, risk management, and they know how to get out of the trade without causing major damage. They will be converting some short straddles into strangles, strangles into bull spread or bear spread. They have multiple types of adjustment techniques, and they can afford for one single strategy, they can go on to fight for 4 adjustments or 5 adjustments. They have such big money. But as a retailer, we are having difficulties. So I'm going to give very basic strategy. In this, only one adjustment we are going to discuss, because more than one adjustment certainly would require more than 1 lakh of capital, and you will not be able to refine it or do further adjustments. For that reasons, I'm going to show only one adjustment, that is extension. And we will also be discussing about what are the things that you need to do, when to initiate, how to initiate, all that we will be discussing. So it involves buying as well as selling. There are 4 legs and all has to be done in basket order. Please do remember that. And selling is done only once, assuming that the market is in the range. It's going to be one time selling. And the weekly edges we are going to buy between 310 to 320. That is all that buying that we will be doing. And adjustments are done under 2 conditions. One, the market has moved towards support or resistance levels, then you can do the adjustment. But if you're in profits and then it has gone to the support zone or resistance zone with time, where the strategy is already in profit, you don't have to do any adjustments. So the only time that we will be doing an adjustment is if it is showing 10% or more loss from the projected profit. 25% or more. Say that projected profit, if you are initiating it and then it shows The payoff shows that you can maximum earn 40,000 rupees, let's say. And then your position, suddenly is showing 10K loss. That's when you will think about doing an adjustment. Before that, we will not be touching anything or doing anything. And what is the risk reward ratio, right? You must be thinking in this strategy, it's very difficult to say how much you're going to earn, because your risk and reward is so flexible, so fluid, it can be confusing. When I say that, the risk is 1 and the reward is 2, all the big guys would be laughing at me, because they know that what sort of money is there in this strategy. Definitely, it is not 1:2, but keeping that your capital is just about less than 3 lakhs, I can comfortably say that bare minimum you can expect 1 to 2 times. Okay, and how the least that you expect from the strategy while initiating it, the better, because you will be amazed to see you might be expecting only 4%, but you can end up making up to 35% is possible, right? So the only thing is that it works in moderate to high volatile, because you are collecting bigger premiums there. In short, low VIX environment where the market is not moving, also people do this, but the returns and rewards are bigger when the market is in a very high volatile environment, because the premiums are super inflated. And the only condition for this is market should not move more than 5% on either direction. So 5% is good, no? Like any side, if it is not moving more than 5%, I'm going to earn money. Yes, the farther that it moves, the lower that you will be earning. Okay. Supposedly you initiate it at say 22,500 today, the market ended, and 24,000 if the market goes, obviously you will be hardly making any money, or probably without adjustments you will be losing. With adjustments you can make some profit, right? But if it is expiring at 22,800, let's say you initiated at 22,500, if it is expiring at 22,800, then you will be making close to 20% returns, or even more. So it all depends on where you initiated the straddle and where the market has expired. So I will not give theoretically too much into this. We can see all that while we are discussing the charts and simulation. Let's show how to initiate this. This involves selling of same strikes on monthly contracts and buying the weekly edges. Very simple. You have to go 35 days to 40 days minimum away expiry. So we are on May 18th, probably June 27th expiry, you can go on writing. Once you do the writing of monthly contracts, then you can buy the weekly edges. But remember, you got to execute these four legs together, right? Together you got to execute. So you need a basket order. All right. So the entry is at least 35 days. But for sure, if you are getting a reasonable return, which you are happy with, exit this trade, or 1 week before the expiry, you exit this trade, because you will not be able to handle the volatility towards the month-end contracts. The volatility, if it breaks on the upside or on the downside, further you will be losing big time. So having waited for 35 days or more and then losing is not a good thing. So strictly exit it 1 week to 10 days before expiry and roll over your positions to the subsequent month. That is the best thing you can do. All right, let's see how the strategy works. So there are a couple of things I am going to show you. One, quickly I'm going to open. So I will be quickly going to sensible. Here we are. All right. What we are going to see is when moment. Okay. What we are going to see is when we are clicking on this strategy builder, right? you see that there are certain ready-made positions. Here we are choosing neutral and then we are selecting the index as Nifty. Okay, here you see there is iron butterfly. So this is called iron fly or iron butterfly, one and the same. When you click this, it's showing something like this. It has gone to 20, I have selected 27th expiry. It has taken ATM straddle 22,500 and then it has got 200 points below and 200 points above. Lakh has the edges. So buying is done. The margin needed for this is showing to be around 52k, 53k. And the maximum loss that you are going to make is 293 rupees. And if the trade goes right, you are making 4,700 rupees. That is 20% returns it's saying. But 50 days or 40 days, will the market stay in this? Nobody can predict. If the market moves here, guaranteed I am going to lose 200 rupees or 300 rupees. If it is going down, again I am going to lose. So I don't like this. Basically, your winning odds can increase depending upon the farther that you go with your um, edges. The farther that you go, let's say you went to 21,800 or 700, and this side you are going, say, 23,000 or 23,200, 300, let's say. Now, this is a better risk reward. You see 4,000 rupees on the downside. On the upside, also 4,900 rupees you will be losing. But if the market stays in this band, then maximum I can earn is 15,000 rupees. But if it is moving slightly lower, then it is 10,000. If it is moving higher, it is like 8,000. You can see that the risk reward is not so precise. It's where depending upon where the market is going to expire, your profitability will change definitely. And also to note that we are not going to wait till the end of expiry. We will be closing 10 days before, so it will be even lesser than that, right? So this also I am not liking it. So what I am going to do is, they are taking the edges on the same month. Why should I give 200 rupees as an edge? Here also, why should I pay 300 rupees as an edge? This is too much of edge, right? I don't want that. So when I remove it, this question can be taken even without edges at a premium of at a capital of almost around 84,000, sorry, 87,000. And this looks good. Now what is happening? You see, I will be profitable up to 5% if the market moves. No problem. I am still making 1,600 rupees. Here again up to 5% if the market moves. Again I am making 600 rupees. Anywhere in between, if it expires, I am going to earn as much as I can for one lot, right? So if it is expiring, say 500 points down, I am making 17,000 rupees on the day of expiry. If it is expiring at 23,000, I am making, say, 15,000 rupees. But what if the market moves beyond that? What should I do? Then we can do adjustments. But this is an excellent strategy even to start off with, right? Now, how can we lower the margins for this? Let's see how well it works. I'm going to 23rd expiry and then say wanted to pick up some small edges of around say 5 rupees I wanted to buy. And here again I'm going to buy an edge of about 5 rupees. Okay. So here again I am going to buy an edge of about 5 rupees. Now what is the margin here? You see, we have lowered it to 58,000 instead of requiring 88,000, 87,000, 88,000. We have brought it to 58k. So we have saved about 30,000 rupees. So if you are having a capital of say around 1,20,000, you can comfortably do the extension and then get into the profits and make sure that you are making good money from the strategy. So if you have about 1,20,000, 1,30,000, there is so much better things that you can do. Even if the market moves more than 5%, you can still get out of this trade in good profits. So I am going to talk about the strategy in detail, and just for the margin purpose, I wanted to show you what kind of things that we can do here. And you can see without edges it requires 87k. With edges it can be brought as low as 58k, and you can use the rest of the money for further extensions. So with that note, let's go and check the strategy. All right, we are in the strategy builder. So like I told you, we are going to focus only on Nifty, nothing else. And the last contract, like in all the other videos, we are going to select the same 25th, and we are going like 1 month or for 35 days to 40 days before, means it should be around March, somewhere around say 13th, let's say, because we have always done some 18th, 15th and all these things. Let's say 13th we have taken, or for convenience maybe 10th. Okay, let's say 11th we have taken this position. Okay, and I am going to keep this. What can be done now? Okay, get the option chain, and market is currently at 22.5. Oh, perfect. If you have initiated it last month, it is exactly trading at 22,500 now. So you can think how much money you could have made, right? So anyway, assuming that the spot is currently at 22,500, and what I am saying is that we need to have a view. So if you are say that you have a bullish view or a bearish wave, then you can choose different strikes as well. For example, you are expecting that the market will go to 23k. You can sell both these legs 23k like this, and but the payoff would look like this. This is kind of risk because you are taking directional view, which means if it is going to expire here, then this sort of straddle can be taken, but the market moves down, immediately you are getting into loss. So I don't want you to take any positional view at this point in time. Probably 1 or 2 strikes higher you can try, but then taking so much skewed is not advisable. So I'm going to delete this and take 22,500 itself. Let's say this is where it is. Let's add. Then 22,500, this is where it is. Let's add. So one lot we have done. You see, we got a perfect straddle. And what is it saying? It is saying 44,805 is the maximum profit that you can expect from this. Now, when I will do the adjustment, divided it by 4, 25% or more, only then I will be doing. So that is around 11,000 rupees. If it shows loss, then I will think of adjustments. Otherwise, I'm not going to touch it, right? For the releasing of margin purpose, I am going to buy some weekly edges. Remember this very simply. I am asked, sir, should we take the same strikes every week for our edge, or it is what sort of logic it is? Simply, I don't want to pay anything to lose guaranteed. One of the thing is that the edges are going to give some sort of protection. It is going to release margin. That is the whole purpose of the edge. For that reasons, I'm going to take something, and I don't want to spend like 30 rupees or 40 rupees on edges. Rather, I will take something around 5 rupees. Let's say, for the study purpose, let's keep 5 rupees as edge. Wherever the market is moving, and then you wanted to do some sort of rollover, suppose the current week expiry has come, you wanted to roll over, then the next fresh expiry that you are going to buy, edges will have the same premium of 5 rupees. That's very simple. So here if I go and then let's say for edge purpose I am going, this is 11th of March. So 14th of March I am going, and 14th of March, for which if I get this option chain, I am simply saying where is 5 rupees. I am not even worried. This is 5 rupees, going and then adding one lot as edge. Here again I'm going 5 rupees. This 4.55 I will take as hedge. Now this is how the payoff looks like. Don't worry about the payoff graph because the calendar spreads usually will not be able to reveal correct picture. So let's see how this one works. So I'm going in 30 minutes or maybe 30 minutes time frame to start with, and update every second. Let's give it and see how it works. So do we need an adjustment? Not at all. We will not do an adjustment until we see minus 11,000 or more. So straight away 3,500 rupees profit. That's pretty good. $4,500. Now think about it. Your investment with the edges is only about 50k, 60k, let's say. You're making 4,700 rupees. Isn't that brilliant? You're making 10 percentage without doing anything for that money, or even say 8 percentage without doing anything. In 1 week has passed, and then just 11th we have initiated, 14th it's already giving you 4,700 rupees. Now close these two things. Probably the edges have expired worthless. You can see here. So 0.05 we have exited, and this again 0.05 exited. Right now I am going to take fresh edges for 21st of March. So again, what is the logic? Simply go ahead and then take 5 rupees. Don't think of anything else. Simply 5 rupees strikes. You buy. Again, here 5 rupees strikes. You buy. And the payoff will look haywire because it is showing the payoff for 14th. I wanted to select 21st. And we are going to see how it looks like. Have we closed all the position? Yeah, these edges are closed. And perfect. This is good. Let's start. Okay, let's start this. So I'm not worried about how the payoff graph looks like because weekly edges are going to throw off. My only concern is if it is showing minus 11k, then I will do adjustment. Other than that, I will not be worried much about what it is showing. Okay, so remember that. Payoff graph can show whatever it is. Like a graph is looking very much skewed to the left side. If it goes, I will be making loss. But I have not seen any loss. It's showing only like either 300 rupees are added or I'm getting, see now it has become 9k, 10k. I mean, perfect. 25% returns already, correct? Very well, you can square this off. Let's see where the market is. Market is at 22k now. You can comfortably square off the entire position and create a fresh straddle if you want, correct? So in 10 days you got, when you initiated it on 11th, now we are on 21st. Already it is giving you 10k, which is 25, 23, 24 percentage already. You want to square off, and create a fresh straddle. But let's say you wanted to continue this. Okay, so we keep it at 0.05 and keeping this as 0.05. It is expiring worthless. Now I got to go to 28th. Select this 28th option chain. Get this 5 rupees where it is. Had this one 5 rupees. Okay, go here, see where is 5 rupees, add here. And I wanted to see the payoff for 28th. So this is perfect. It's showing like this. I don't care. I am going to simply I'm not going to worry about the payoff, how it looks like. My question is that if it is showing minus 11k, I'm going to do the adjustment. Otherwise, no adjustments. So let's click on play and see what happens. So let's go and check. 11k, 12k, 13k, it's good. So 28th it is. Again, both these things expired worthless. I'm going to close it at 0.05. Modify this and 0.05, modifying it, and going on to take the edges of the next week, which is 4th of April, and select the payoff for 4th of April and get option chain. Go here, add 5 rupees. So 4.7. Okay, buying one. Here I am again going 4.85, buying one. And here is the payoff for April 4th. Yeah. So the payoff for April 4th looks like this. I'm going to click on play and see. 14k, 15, 17. So this is all great returns. If you see, amazing returns. You're getting for a capital involved of 60k, 18,000 rupees is quite big, isn't it? So this is 4th of April and we have both these strikes expired worthless. 0.05, modify, 0.05, exited. So we are going to the next expiry, which is on 10th of April. So I'm going to 10th of April and get option chain. Yeah, 5 rupees. Here it is, buying one lot. On the call side, again I am going buying a 5 rupee strike and ensuring that the payoff graph is selected for 10th. Okay, let's click on play. Yeah, 19k, 18k, 17. Almost it's standardized around 18k, 17, 18k. It is standardizing. That's pretty good thing. So about 18,800. So both of these expired worthless. You can see it. So going to modify and modify, exit at 0.05. Perfect. Now Another expiry I'm going, that is 17th. Oh, 18th is the expiry. So I will switch it to 18th for the payoff. And getting the option chain, 5 rupees we are going and buying. Here again 5 rupees. Yeah, exactly at 5 we got something. Okay. Now payoff looks very weird. Let's see this. So 19,500, 20, 21K, 22, 23. Brilliant. 24,000. So at some point it was showing 24,000, right? It's brilliant return. 26K. So suddenly it has dropped to 16,900, right? From 24K. Before this week position that we have taken, it was at 18K. It went and showed so much of good profit, 24K, and suddenly it has dropped. Now, this week also expired. So, the next week is 25th. We wanted to exit at the last week itself. So, we will not be typically carrying it. And let's say that we wanted to carry it. What will happen is we got to buy more edges and then close this at 0.05, modify and exit. This again, modify and exit. Because the last week is very volatile week and then we are already here at the extremes, right? Now, let's say I want to learn adjustments for this because you have not shown me adjustment. This is perfect time to show you the adjustment because 1 week to go, it has come down here. Although I would have booked it at 23, 24K when it was showing, that is ideally the best time to close and switch over to another strike for next month expiry. But assuming that we wanted to stay here, so what is that extension I wanted to do? Here, my call side is showing 26,000 rupees profit. Here you can see and my put is showing 6,000 rupees loss, correct? So let's go and check this strike in option chain. What is it trading right now? I have to select the expiry as 25th, correct? So 25th expiry, get option chain, 22,500 is trading at 475 rupees and my call is trading around 23 rupees, correct? Now, this is where people do crazy things. What they will do is they will think that 23 rupees is nothing. Let me close this leg and then, write 50 rupees leg or 75 rupees leg. Or maybe why don't I, move it to here and then write this leg. These are the blunders that you will be making. Please, I am telling you very clearly, this is why option writers also lose money because they don't know how to do the adjustments. They are simply going on to do something to match up this value because it is showing 500 rupees over here. 22,500 is around 475 rupees. Now they are trying to cover that by going closer and then writing. What if the market reverses from here? This will become an ITM strike and you will be losing. You have sold it at 163, but this will become 500. Now that is very, very bad. Now what you have to do is you are seeing that the strike is at uh, 475 and all I am going to do is when I divided it by 2 because your capital is very limited, you have to divide it by 2 only. Then what will happen? What is that requirement for when you divided it by 2? 200 and let's say 38. Okay, 238 rupees. Now market is here. Which one is 238 around this level, right? Now, still, where is the market trading? You see this 21,900. Still, it's an ITM strike, but it is better than having 600 point OTM as written. So what we can do is to go around here. Ideally, what I should be telling you is divided it by 4 and then 5 and then write this strike 5 times. But you don't have money for 5 times writing. It will be really helpful if you do that. But I understand you don't have money. Then you got to do what best you can do at this stage, which is to write this 2 times. Add this position, and I am exiting this at 475 rupees. So this leg I will be exiting at 475 rupees in loss, correct? But at the same time, I'm going to, I have sold this. Oh, this has to be a sold position, correct? Not buy. This is selling, modify. Now it looks like this. 2 times I have written, okay? And I'm going to again buy a weekly edge of 5 rupees. This is all not worth it to do on the last day. But let's say what would have happened. I am buying a 2 times edge I am buying because I sold 2 lots of put. But 1 time call I am going to buy because I have only 1 position of call. Correct? So if you see, this is how the payoff looks like, which is far better, which was far better. Now, what happened? This one I sold at 558 is currently at 23 rupees and giving me a profit of 26,000. And freshly, I have taken a put position by dividing this value, which was at 475 rupees. Now we sold it at 338, but it became 475. Now we divided it by 2, it is roughly around 237.5. But I don't get that strike, so I am writing 247 rupees strike 2 times and got 2 edges for the put and 1 edges for the call side. And now I am going to try what is it and see how much I am going to make. Oh, I have to select the expiry as 25th now for April. Sure. I'm going to click on play. So 4,000 rupees, 7,000 rupees. Is it truly worth it? See, again it has come back. 24, 30. $36. My God. It's on a rampage. So 40K it is showing. Okay. Net to net, it expired with a profit of 37K for an investment less than 90K, right? So even if I am keeping it 90K as the thing, I will, we have taken edges, it has become 58K. Let's say that you did double writing here and then the margins have gone to say 1 lakh. So throughout it was not 1 lakh, but throughout it was not even 58. It was somewhere in between. Let's keep it even for 1 lakh. 37,000 rupees is a huge thing. But I have to give you certain warnings. If you see at one point, from 16,000 it went to 2,000 rupees. Correct? And it that week it gave 37K. From there, 2000, it has recovered and then it gave this money. But what happens if it further falls? You are waited for 45 days, getting into loss, and then you are closing that position in loss of say around 5,000 rupees. It will pain you, right? Why that happened? Because we took an edge which is still an OTM, sorry, ITM. ITM is in the money. Market was trading at 21,900 and we are going on to write 22 200 or 200, which is in ITM. And if the market collapses from there, we are going to lose money. That's why it's better you don't do any adjustments. Whenever you see a profit, after waiting for 15 days, 20 days, it's giving you some good money, book it and exit. If you continue to wait, uh, you should have more money. Like for example, I showed you how you can close one leg and then take two legs of the put. Probably you can switch it further far away and then get more range and write for 3 times and buy edges 3 times. Something like that you can do. So that is not the only way of adjustment. I'm telling you, there are multiple ways. More than five types of adjustments are there for short straddle. But this is the cheapest and cost effective way of doing it. So keep that in mind and trade with caution. Always roll your positions. Don't wait till the expiry. Waiting till the expiry, you saw the results. It could have become 2000 or it could have become negative, or luckily this has given 40,000 rupees also. And while it closed where it closed, we will see that, because having come this close, let's go and see at 330 what was the return. 38K. So which is fine, right? uh, so you had a terrific luck that it ended in your favor without capital. But if you have money, then brilliant strategy it is. You can go on to experiment it. Do the paper trading. Of course, no strategy works 365 days. It cannot happen. You got to be very flexible. You got to be very fluid in adapting to the changing market conditions and do something creative. It's lot of times people think that linearly. I did this back testing. I am putting all this formula and then created a script. Tried it. It is not working. Of course, you have to use your brain, you got to use your intelligence for adjustments. It will just, the conditions and criteria you are just simply passing to a mission to do. But you are the one who is going to analyze the market and take a call. If it is breaking, it is going to break this particular zone, then we are going to have a bigger fall. Or if it is rebounding from here, then it can come back. So that sort of dynamic decisions only you can make and no scripts can make, right? And you can decide how many times you want to split that call and then write it, or you wanted to learn some other adjustment techniques. There are many different ways to do it. So no strategy would be giving you 100% result. So I really have not come across one strategy that works 365 days. So uh, I'm just giving you all this as a knowledge, and whatever I have learned over the years, I'm sharing it with you for your consumption. And how you want to refine it, it's up to you. And you are responsible for your losses and profits. Of course, I am not a SEBI registered guy, and this is all for education purpose. You go on to do your own testing, experiment it, do the paper trades, and see how it works for you. So with that note, I end this video. All the very best. Looking forward to see you all in another one. Thank you.